A complete financial model contains the three main statements: P&L, balance sheet, and cash flow. The P&L tells us how a firm performed, or is expected to perform in a given period of time, whether it was profitable. The balance sheet shows what the company owns and owes. And the cash flow statement indicates how much cash was made in each period. And all three are necessary to carry out a proper analysis. Therefore, we'll use them in the forecast period. We shouldn't forget the three statements are interrelated. P&L items affect the balance sheet and the cash flow. At the same time, the cash flow statement feeds the balance sheet. Financial models should be built in a way that respects these relationships. So, if we know that net income, the bottom line of the P&L, is one of the components forming a firm's equity, we must build this relationship into the model. Net income will be calculated first, and then it will be added to equity in the balance sheet. There are several relationships between the income statement and the balance sheet: revenues and trade receivables, COGS and trade payables, D&A and fixed assets, interest expenses and financial liabilities, net income and equity, and the list goes on. The cash flow statement and the balance sheet are connected. The most obvious item that forms this link is cash. When we add net cash flow obtained in a given year to the beginning balance of cash, we would obtain the amount of cash the firm has in its bank account at the end of the year. So, we need to take into consideration these relationships to build a proper financial model, right? If we don't, the balance sheet won't balance, and that means we haven't built a solid model. So we have to make sure the model build balances for historical and forecast years.